A lot of people are interested in new ways to make money, and one of those ways which many people are thinking of is the stock market, but many people simply do not know where to begin. Let's take it right back to basics and look at what the stock market is and how the stock market actually works. This is going to be a basic but brief introduction, looking at how stocks are traded and how things really work in the stock market. You're going to want to subscribe for this one, as you will learn a lot. When we think of the stock market, we often think of overcomplicated charts, traders and big banks and numbers constantly moving up and down. And whilst these all can be components of the stock market, there is a lot more, and it's very easy to understand when we simplify it. The big complex charts are something learned through time and experience, but the overarching concept of the stock market is really simple and very easy to understand. So let's take it back to basics. On the front of it, the stock market is a really easy concept and can be described simply as a place that companies go to list their brand to the public as a way to raise extra cash. A percentage of a publicly traded company will be listed on the stock market, and every single time that a stock is bought, somebody buys a small share of that company. What the share actually amounts to is a more tricky topic. A share could in theory be worth 50% of the business, 25%, or 0.05% or less, depending on the company's share structure, but let's not overcomplicate things for this beginner video. The stock market is really a place that companies go to make money, and that is true, but what you're probably thinking is, how can you make money on the stock market? Well, whilst companies raise capital for listing their shares, the shareholders, i.e. the buyers of the stock, may be rewarded as the company's valuations grow in the future, as the shares bought will increase in value. Let me explain a really easy example of this. Here we have the Apple stock chart, and you can see that the company developed and grew over time, and as its revenue and market share increased, the price of the stock rocketed, as is seen by this chart. This chart goes from about 2005 all the way to 2020. When we look at the chart, we see one thing's clear. People who bought in earlier, for instance in 2010, saw a massive benefit to buying their shares as demand for Apple products increased. Imagine, you bought Apple stock back in 2005, 2007 or even 2010. Back in 2010, the iPhone 4 was the newest iPhone. Think about all of the new products that Apple has made since then, the iPad, AirPods, all of these brilliant products. And as a consequence of this, Apple has increased their sales and their revenue has grown, and therefore their perceived value and share price has also increased. So that shows that if you buy in early, you do have the potential to make money, but the opposite can also be true, and if you buy in at a bad time, you have the potential to lose. But we'll talk more about this in a minute. And that's really what the stock market boils down to. As the demand for a stock increases and the price goes up, the people who bought in earlier can have the potential to take profits, as new investors are willing to buy the same shares at a greater price. And there's a number of reasons why this may be. Again, in the case of Apple, the company released some new products and had massive news, but in different companies it can be for different reasons. But the same can also be true in inverse, and this is important, as a lot of gurus don't want to tell you this, but if the demand for a company decreases, the share value will go down in value. And again, nobody will be willing to pay the former price, so the same asset will drop in value. So if you bought and it went down, you lose money. If you bought and it goes up, the opposite is true and you make money. It's a really easy concept to understand, but people don't really understand it when it is presented through the stock market. So let's put it into a different scenario. Let's say that we buy a house. Let's say that I buy a house for £200,000. The house has been sold to me at this price simply because somebody was willing to buy it. In this case, I was willing to buy this house for 200k, so that's a fair value. Let's say 3 years later, I find an issue with the structural integrity of the house, but want to still sell it. The problem is, now I can only sell the house for 150k, as the demand for the house has gone down because it is such a hefty project and people don't want to do it, so the value of the product has gone down. Alternatively though, let's say that the structural damage doesn't happen. Let's say that 3 years later the house is in good condition and it has no issues. Now I can potentially sell the house for 225k because the value's gone up and because a new school has been built in the area. Because now the potential for people willing to pay more has gone up. And that's how the stock market works. When people want to pay more for a product as it is seen as more valuable, the price of stocks goes up. It's a very easy concept to understand, and the stock market can be explained in this way. The overarching concept that needs to be remembered is this: profits are determined by a stock's price. Increases in the price can be triggered by demand increases as people are willing to buy more and more of the stock. Now, there's no exact science to picking the right stocks. If there was, every single trader would have a 100% success rate and be billionaires. Unfortunately, the value of assets can drop as well as increase if the demand for the company goes down or dries up. So hopefully this was a useful introduction to your investing journey. It was a really easy to understand video and I tried to simplify it as much as possible. Because of this, we did miss out a couple of things, but don't worry, we're going to be continuing to make this series if you guys enjoy it. And hopefully it will start you and trigger that first step in your investing research. Thank you so much for watching, and I'll see you next time.